Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. In this video we will be doing an analysis of Chipotle and seeing if it would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Now, let's go ahead and jump right in. Cue the logo. Let's start with some background info on Chipotle. Chipotle was founded in 1993 by Steve Ells and his friend, Monty Moran. The company started in Denver, Colorado with the mission to serve responsibly sourced and classically prepared, real food. The company's menu features burritos, tacos, bowls, and salads, all made with fresh, high-quality ingredients. Today, Chipotle is headquartered in Newport Beach, California and currently has over 2,700 restaurants in the United States, Canada, and Europe. They have been expanding steadily and have recently announced plans for franchised Middle East locations. Now, let's look at the price action. Starting with the 1-year chart, we see that Chipotle had a CAGR of about 41%. Zooming out to the 5-year chart, we see that Chipotle had a CAGR of 33%. Chipotle price action has been steadily climbing over time. This is what we want to see. Now, let's take a look at the fundamentals. Gross margin is 41%. This is beautiful. Revenue has compounded at around 15% over the past 5 years and has reached nearly $9.3 billion most recently. Very good revenue growth with strong gross margins. And, with inflation moderating, gross margins will likely increase further. Looking at free cash flow, we see a 29% CAGR over the last 5 years, while capex has increased at a CAGR of 15% and stock-based compensation increased at a 8% CAGR. With Chipotle and many other restaurants leaning into automation, it is not surprising to see capex grow. Notably, free cash flow is actually outpacing capex, which is very good. Stock-based compensation has been kept negligible and account for just 10% of free cash flow. This means that in the most recent trailing 12 months, Chipotle had about $900 million that they could use to invest in the business, buy back shares, pay down debt, and or make acquisitions. Speaking of buying back shares, weighted average shares outstanding have been decreasing over time, going from a high share count of 28.5 million in 2021. The share count today is around 27.8 million. As Chipotle continue to produce impressive free cash flow, they will continue to buy back shares. The only mild concern around this is making sure that they avoid buying shares when the share price is too expensive. Now let's view return on capital employed. For whatever reason, Stratosphere has decided to do away with the widely popular metric of return on invested capital. If anyone from Stratosphere is watching, please return my favorite metric. This is also a good time to briefly explain the difference between the two metrics. Return on invested capital measures the efficiency of all invested capital used for business operations, while return on capital employed measures the efficiency of all capital in a business. While return on invested capital essentially uses net income in its formula, return on capital employed utilizes EBIT, or earnings before interest and taxes, and is a more broad assessment of company efficiency than return on invested capital. Anyway, back to the chart. So the return on capital employed has increased from 19.9% in 2018 to 23.1% in 2023. This is what we want to see, a high and growing return on capital employed. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from -5 days in 2018 to -6 days most recently, Chipotle is demonstrating improving efficiency over time. This means that Chipotle gets paid about 6 days before paying for the materials needed to prepare and sell their products. Last, let's explore Chipotle's debt metrics. I like using the net debt to EBITDA ratio because it shows debt in relation to the company's earning power. Chipotle's net debt to EBITDA is beautiful at 1.1. Even better, the net debt to EBITDA has been declining since 2020, meaning the company is slowing paying down debt relative to rising earnings. The fundamentals of Chipotle are amazing. This is truly like the best company ever. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Chipotle. It is a restaurant company with a gross margin of 41%. The 5-year revenue per share CAGR is 16% and the 5-year free cash flow per share CAGR is 30%. Whoa, just amazingly perfect. A return on capital employed of 23% is very good. Next, the cash conversion cycle of -6 days is also very good. Concerning debt, a net debt to EBITDA of 1.1 means that Chipotle could pay off all of their debts with a little over 1 year of earnings. So from a fundamental standpoint, Chipotle is super strong. The question is, will the consumer remain strong enough to continue buying delicious burritos? Now let's switch our attention over to valuation. Chipotle is somewhat overvalued relative to the S&P 500 with a ratio of 1.8. The price to earnings growth, or PEG ratio, is 1.9, which is actually pretty reasonable. Chipotle is a very strong restaurant company that has achieved massive growth to date. I do still have some concerns. Though inflation has fallen a lot since last year, the next 100 basis points drop from 3% to 2% may be much harder to achieve and will likely require the Fed to continue raising interest rates. Additionally, the student loan restart is expected to impact the business and may further compress growth in the short term. All in all, this is a great company and is definitely going on the watch list. Many thanks for watching. What do you think about Chipotle and its amazing growth? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.